Hey everyone, for those of you who don't recognize my face or my voice, my name is Carl Lindgren and I'm one of the wealth advisors here at Stabler Wealth Management. Just wanted to come to you today and bring you a quick update on some of the tax initiatives that we've seen here in Washington State. As you may remember, there is a capital gains tax that you probably heard about recently, as well as a long-term care tax coming down the pipeline that you may remember from a couple of years ago, may not have heard about recently, but we can kind of jump right in and take a look at what some of these new tax initiatives are. So, like I said, there's a couple new taxes here in Washington. And what we'll do is we'll take a quick look at, how we got here, give you some background on the taxes themselves, and then where we are now, and then of course, what to expect going forward, and then if there's any actions that you should take. So what we'll do first is we'll talk about the capital gains tax. So as a reminder, you have a capital gain if you buy something and then sell it for more than you bought it for. That's a capital gain. As another reminder, there's a federal capital gains tax you probably are aware of. The state of Washington capital gains tax is totally separate from the federal tax. So we're just talking about the state of Washington capital gains tax right now. So in terms of history, this capital gains tax was initially passed back in 2021. It was set to take effect in January of 2022. So what that means is that any gains starting January 1st, 2022 would be taxable under the state of Washington's new law. What this is a 7% tax on any capital gains over $250,000. So if somebody bought Amazon stock back in the 1990s for $1,000, and then sold it last year for $350,000, they would have a $349,000 capital gain. With that $250,000 exclusion, they would have a $99,000 taxable capital gain for state of Washington purposes. And so that would, at a 7% rate, that would be about $6,930 worth of tax for Washington State. Important to mention that, that $250,000 exemption, that's both for single people and married couples. So if you're single, you have $250,000 exclusion. If you're married, you also, as a couple, have a $250,000 exclusion. This tax doesn't apply to certain assets, certain income, as far as doesn't apply to anything in your retirement accounts. It doesn't apply to real estate, just to name a few. There's some others as well, but those are kind of the two big ones. And then in terms of history, what essentially happened is back in March of 2022, the Douglas County Superior Court, after a handful of lawsuits, declared that this tax was unconstitutional under the state of Washington. Now, the state more or less expected this to happen. And so what the state did at that time is they went ahead and appealed to the state Supreme Court. The Supreme Court at the time said, while we debate this, we're going to go ahead and talk amongst ourselves and debate this, and we're going to let you collect this tax in the meantime. And then, as you probably heard back just a couple of weeks ago, the state Supreme Court came out and said, this is legal under the state constitution. You have a right to collect this. You, the state, have a right to collect this. And now we, Washington State, officially have a capital gains tax. So in terms of where we are now, the tax itself, for anything in 2022, the tax is due April 18th, 2023. This is right around the corner, and it's the same day as your federal income taxes. Now, it's a totally separate tax, totally separate filing process. So you'll definitely want to chat with a tax advisor as to whether or not you need to pay this and how to pay it. The state has indicated that penalties and interest will apply if this tax is not paid and filed in a timely manner. So you'll want to make sure that you chat with someone to make sure that you're avoiding any penalties and tax if you have more than $250,000 of gains. In terms of whether or not there's any other way out of it, those groups that applied or filed a lawsuit back in 2022 to say that this is illegal, they are trying to figure out a way to push this into the U.S. Supreme Court. Honestly, that's a bit of a long shot. The U.S. Supreme Court tends to stay out of, state law, but we'll see what happens. We'll keep our finger pretty close to the pulse on that and let you know. And then as far as what happens next, there's really, the big elephant in the room is whether or not this paves the way for an eventual state income tax. Fortunately, the way that the Supreme Court interpreted this is they said, this is a capital gain or a excise tax as opposed to an income tax. And so because of that, that's how they're kind of rationalizing the way that it's legal. And that does create another hurdle if the state ever wants to add an income tax. Honestly, I think the larger concern for most folks is going to be whether or not this creates a situation where the state can lower that exemption amount from 250,000 to something lower, such as 100,000, 25,000, or some other number, or if they can raise the rate from 7% to another number. So again, we'll pay pretty close attention to that and let you know if we have any thoughts as far as where the state's going with that. Again, really important, chat with your tax advisor as far as whether or not you need to pay and how to pay. Feel free to reach out to us if you have questions. Always happy to chat with you. With that, we can move on to the long-term care tax. So again, this was one that you probably heard about back in 2021. There was a bit of discussion of it back in 2021, but you probably haven't heard much since. So as a bit of background, what this was actually back in 2019, this was set up. And it was a 58 basis point tax. So 58 basis point is 0.58%. And it was a tax on all W-2 income. So in terms of, scaling that, that's about $580 per year on $100,000. Now that doesn't seem like a ton of money, but, over time it adds up. And particularly if you're someone like our, Seahawks quarterback, Geno Smith, who just signed a $105 million 3-year contract. That $105 million is going to cost him $609,000 in tax if he doesn't have a long-term care policy already to exempt him out of this. That $609,000 of tax, you can compare that to about $1,700 or so versus someone who is earning about $100,000 a year over a 3-year period. Now, this long-term care tax is not applicable to certain types of income, such as investment earnings, Social Security, retirement account draws, just to name a few. And as far as a benefit, it's about a $36,500 lifetime long-term care benefit for those who qualify. Now, to put that in context, in the state of Washington, long-term care averages about $2,600 all the way up to $10,000 a month. Based on the level of care. So again, that can be up to $10,000 a month in costs. The tax itself, if you qualify for the benefits, will get you about $36,000 over the course of your life in benefits. So, it definitely does something, but in terms of what the costs might be, it's a kind of a drop in the bucket. What caused all of this stir back in 2021 is that the state came out and said, all right, hey, let's give people the option to opt out of this if they have their own long-term care policy in place. Most people prior to that, if they had a long-term care policy, it was something really substantial, probably pretty expensive, and had a really good benefit along with it. What happened with this tax and when they offered this exemption is a lot of people just started applying for really basic long-term care coverage just so that they could opt out of the tax. Now, if you had a policy in place before November 1st, 2021, you could apply for an exemption. The deadline to apply for that exemption was December 31st, 2021. The state would then take a look at your request and then potentially issue you an exemption letter. If you have that exemption letter, you are exempt from this tax. Starting in 2022, the state got together and voted and said, hey, let's punt this for a little while because there's some concerns out there. It's not super clear on certain things. And so they kind of pushed it off to 2023 and gave themselves some time to address some of those concerns. So where are we now? Well, they've addressed all the concerns they wanted to address. And so they're going to start collecting that tax July 1st, 2023. At this point, you cannot apply for an exemption, at least in terms of applying for an exemption based on having your own long-term care policy. There are some exceptions to that. You should discuss with a qualified tax advisor if you think you might qualify for an additional exemption. But in terms of having that long-term care policy in place, you had until December 31st, 2021 to apply for that exemption. The state has indicated that you do not need to keep your policy in place in order to maintain that exemption. So what that means is you can cancel your policy. For instance, if you got a policy back in 2021, specifically for the purpose of getting out of this tax, you can cancel that policy and you can still remain exempt from the tax. Now, I think it's important to mention, I'm not saying at all that you should go out and start canceling your policies. Please, please, please contact us, contact your wealth advisor, just to make sure that you're not canceling a really good policy. But it's just good to know that, in terms of maintaining a policy, you can really focus on the merits of the policy now, as opposed to making sure that you're out of this tax. Chances are there's really not a good chance you're going to get a refund of any of the premiums paid. Those are probably all just sunk costs at this point. But the important thing is to make sure that you have your exemption letter that the state issued you. And I'll show you in the next slide how to access that exemption letter if you don't have it. The reason that's going to be important is because you're going to want to provide that to your HR department or your payroll department, both for your current employer, but also for any future employers. That's going to be your get out of jail free card for this tax for the rest of your working career in Washington State. And again, let us know if you have any questions about maintaining a policy. It'll be really important, and that's a big decision to give up a long-term care policy. Really important to make sure you're considering all of the pros and cons around that. So then in terms of how to access your letter, let's say you've misplaced your letter, for example, the state should have mailed you a letter, but they also make it available online. So if you've misplaced your physical letter and you want to access it online, what you'll want to do is go to Secure Access Washington. That's a website where you can log in. You'll just put in your username and password. If you've misplaced your username or password, you can just click that forgot your username or forgot your password button. Once you log in, you should have access to this paid family and medical leave section. If you click that Access Now button, that'll give you access to this next website where you can actually get your exemption letter. So in terms of actually accessing your exemption letter, this guy here on the right, this little screenshot on the right, is going to be what the website's going to look like. And that right there is what you'll want to click on to actually access your exemption letter. You click that and you can download your letter. Your letter will look like this here on the left, and that's the letter that you want to make sure that you provide to your current employer as well as any future employers before July 1st to make sure that they don't take that tax out of your paycheck. So if you have any questions, don't ever hesitate to reach out. Reach out to your wealth advisor, me, Sean, Dave. We're all happy to chat with you. Our direct line to our front desk is 425-646-6327. You can also email us at info@stablerwm.com. So with that, really appreciate your time. Again, don't ever hesitate to reach out, and good luck and happy tax season.